Hi, this is Joe from Prep Agent. Today we're going to go over some finance questions. But before I do that, as always, check out our social media outlets if you want to communicate with us and other people just like you who are taking the real estate exam. And keep in mind, our goal is to keep things as simple as possible. We don't want to make complicated concepts more complicated than they need to be. So with that being said, let's jump into some finance questions. Okay, and our first question of the day. Why would a lender have an appraisal on the property? A, to determine the value of the property. B, to assure the property value is sufficient to cover the loan. C, to protect the buyer from fraud. Or D, to make sure the buyer did not pay too much. Give everybody a second. And the answer is to assure the property value is sufficient to cover the loan. I want to talk about this for a second. So the appraiser is not there to determine the value of the property. They're there to make an estimate of the value. The true value of the property is whatever a ready, willing, and able buyer is willing to pay for it, what somebody could get on the open market. Now you have to remember this is important to the lender because this is the lender's collateral. If you borrow $100,000, they need to make sure that your property is worth more than $100,000 so that if you don't pay them, they could sell their property to recover their debt. Now, obviously, it's an overly simplified example, as there are other factors like down payments and whatnot, but that explains the concept pretty well. So let's move on to the next one. Which of the following loans would be most likely to qualify for FHA insurance? A, a loan to purchase a farm. B, a loan to buy farm equipment. C, a loan to buy a small business. Or D, a loan to purchase 1 to 4 units of residential rental property. Okay, and the answer here is D. Okay, before I get into this too much about the question here, let's go over what FHA insurance is. You do not get an FHA loan. People very often make that mistake. You get a loan that is insured by the FHA. FHA's insurance protect lenders against default. Now, where this comes in is for residential property. It's not for business. Residential is typically defined as 1 to 4 units. The other things are not residential. You got to remember your real estate exam is basically a test to protect residential purchases. There will be some stuff regarding other types of real estate. But if you're not sure about an answer on the exam, and one of the options is residential and the other has to do with commercial, go with residential, and that could be a pretty good guess. When making a loan, amortization tables are used in order to determine the APR, monthly payment, interest rate, or term of the loan. Okay, and the answer here would be monthly payment. There's not a lot of tricky memory techniques here. If you Google amortization table and click images, you'll see all it is just a nice little graph scheduling your monthly payments until you don't owe anything more. Just remember, amortization tables are used to determine the monthly payment. In deciding whether or not to make a specific home loan, a lender would consider which of the following factors most important: the availability of mortgage funds, federal and state laws, the degree of risk, the general economic outlook. Take a second. Let's give everybody a chance to answer here. And their answer is the degree of risk. So there's a few things to help you determine this answer. So it says in deciding whether or not to make a specific home loan. So this is to a person. Okay, you got to remember that. This is a loan to a person. Why do I bring that up? Because the other three options are not specific to any person. The degree of risk has a lot to do with a person: their income, their credit history, the type of property they're buying, and whatever other factors the lender wants used to determine the degree of risk. The other things are much more general to the economy and surrounding influences. So you also have to remember, it's all about risk for the lender. Your interest rates go up if you're a higher risk, goes down if you're less risk. That's why credit scores are so important. But it's all about taking down the risk for the lender. That's why we got that appraisal that we mentioned in a previous question. So if your property's worth a lot more than the loan, you're less risk, and they're willing to make you that loan. If the property's worth a lot less than the loan, then they're probably not going to give you the loan. A balloon loan could also be described as a partially amortized loan, non-assumable loan, due on sale loan, or fully amortized loan. See what you guys think here. Okay, and the answer here be a partially amortized loan. So there's three things I want to go over here. Okay, actually four. So when you have your amortization tables, a fully amortized loan, if we want to use really simple examples, be if I lend you $10 and you're paying $1 a month, then at the end of 10 months, you wouldn't owe me any more money. Okay? In a straight note, you would be, if I lend you $10 and you pay me only the interest on that loan, then your balance stays the same. Okay? Negative amortization would be if I lend you $10 with $1 interest a month, but you only pay me 50 cents every month. Your debt would go up. Whereas at straight note, if I lend you $10 and you paid me $1 interest a month, then it would stay the same. A balloon loan would be, for example, if you owed me $10, you pay $5 5 on that. The terms of some real estate loans provide that interest rates may increase or decrease depending on the money market conditions. We call this type of loan A, fluctuating market condition loan, B, a loan which is secured by a short-term land contract, C, a variable interest loan, or D, an interim loan. Okay, and the answer here, variable interest loan. So just by nature of it changing makes it variable. The word variable means it could change. So it's a variable interest loan. Which lender is the major source for junior loans negotiated today? Federal Land Bank, commercial banks, insurance companies, or private lenders? Okay, see what you guys think. Okay, so what's a junior loan? That's that second loan, and usually it's a higher risk and therefore has a higher interest rate. Usury most nearly means making loans without the benefit of cosigners, lending money at fluctuating interest rates, being capable of multiple usage, or illegal rates of interest. Okay, illegal interest. So this is basically lending to people and taking advantage of them by charging obscene amounts of interest. You may have heard the term loan sharking when you watch all those gangster movies. This is what this is. Usury is basically loan sharking. You're lending people money and you're charging an illegal amount of interest in an effort to take advantage of them for your own profit. A promissory note is an agreement to perform or not to perform certain acts, is the primary evidence of debt, is it guaranteed by a government agency, or may not be executed in connection with a real estate loan. Let's see what you guys think here. Okay, the promissory note is the primary evidence of the debt. The whole lending process starts there. Now, a promissory note does not need to be a complicated thing. It could be me writing on a napkin that I owe you money. That's all it has to be. It's just evidence of the debt. That's it. And before you get a loan or anything like that, you got to sign over a promissory note, which is saying that I owe you money. The amount of a loan expressed as a percentage of the value of the real estate offered as collateral is the debt to equity ratio, amortization ratio, loan to value ratio, or capital use ratio. Okay. And the answer is loan to value, how much they're lending in relation to that estimated value of the property. Now, one thing I want to mention here is some people ask me if this is for their state. The questions we go over here apply to everybody. This is national content. We're not going over state-specific material on this webinar. So if you're watching, doesn't matter what state you're from, this is all good info for you to know. Okay, why would a lender have an appraisal on the property? To determine the value of the property, to assure the property value is sufficient to cover the loan, to make sure the buyer did not pay too much, or to protect the buyer from fraud. Okay, let's see what you guys think here. So we went over this before. Is to assure the value is sufficient to cover the loan. Remember, it's all about risk for the lender. The lender checks what kind of risk it is by having an appraiser do an appraisal on the property to make sure the value is more than the loan. Okay, let's go on to another one. Which of the following describes a mortgage that requires which of the following describes a mortgage that requires principal and interest payments at regular intervals and is called the liquidation of a debt by periodic installments until the debt is satisfied? Amortized loan, annuity loan, assemblage loan, or acceleration loan? See what you guys think here. It's amortized. And remember that amortization table shows those monthly payments. Which of the following is true for a second mortgage? It is usually issued at a higher rate of interest. It cannot be used as a security instrument. It has priority over the first mortgage. It is not negotiable. Okay. So your interest rate is related to your risk. When you have two loans, the first loan takes priority. And if something happens where you can't make the payments, the first loan get paid off before the second. Therefore, the second is a higher risk. It would have a higher interest rate. So I'm really happy people are trying to answer in the comments section. If anybody else wants to keep doing that and ask questions there, be my guest. The interaction between everybody watching is a great thing. We all learn more when we learn together. So keep commenting as we do this. When the amortized payment of a mortgage remains constant over the period of the loan, but leaves an outstanding balance to be paid at the end of this payment is called a satisfaction payment, an escalation payment, an acceleration payment, or a balloon payment. Which one do you guys think it is? Okay, and the answer is balloon payment. So we've seen this concept now in many different forms throughout this webinar. So the balloon payment is when you make one big payment at the end. And remember, it's a partially amortized loan. This also goes to the point where I always tell people, don't memorize the questions. Memorize your vocabulary. And if you can, learn the concept. So if you memorize the question and you don't get the exact question on the exam, that's a problem. But if you know your vocabulary and understand the concept, it doesn't matter how they ask it. You'll get it right either way. The seller under a land contract is called the grantee, the vendor, the vendee, or the grantor. Okay. And they're the vendor. They are the seller. There's the vendee receives the property. Good job, person who wrote the OR. Remember your ORE rule. Remember, the lessor, vendor, grantors give or the proprietor for your pleasure. EE, lessee, vendee, grantee, receives property, makes you happy. It's better with the OR, but whatever helps you get past, right? Ugh, a long word problem. Horrifying, isn't it? Okay, but here we go. Carol made an offer to purchase Greg's property. As part of the offer, Carol agreed to take title subject to an existing VA loan, which Greg obtained when they purchased the property in the approximate amount of $39,000. If Greg sells to Carol under these conditions, which of the following is true concerning liability for a loss suffered by the government after a foreclosure on the VA loan? So, liable. Greg will be primarily liable. Neither person is liable because Carol took title subject to the existing loan. Greg and Carol will be liable. What do you guys think? Give you guys an extra second in this one because it's a little longer. Greg will be primarily liable. Okay, so you have assume and subject to. Because you have assume, that means the new buyer's assuming the loan, taking it over. Subject to means I'm taking it over, subject to the fact you're responsible for the debt. Therefore, Greg is responsible here because Carol took it subject to. And Greg was a seller, so as it says in the explanation, the seller will be primarily liable. This is the first question we did today, but let's see if everybody remembers the answer. Which of the following loans would be most likely to qualify for FHA insurance? A loan to purchase a farm, a loan to buy a small business, a loan to buy a farm, a loan to purchase 1 to 4 units of residential rental property. What do you guys think? Remember what we said about this before. This is basically a test in residential real estate. Not always the answers are residential, but if you're not sure, it's a great option to go with. An investor paid $300,000 for an apartment building, making a $75,000 cash down payment. 1 year later, the property increased 10% in value. This resulted in a $30,000 or 40% gain on the $75,000 equity. This is an example of leverage, plottage, highest and best use, or none of the other options correct. Is it D, C, B, A? What do you guys think? Okay, and the answer is leverage. All right, leverage is the concept of using other people's money, and that's what they do in this example. They use other people's money so they can get the property and gain that equity. Remember, the equity is the money that is in the property above and beyond all liens against it. Liens are when you owe money. Just out of curiosity, in the comments to the side, can you guys name a type of voluntary lien? Let me see if the guys write in the comments. Can you name a type of voluntary lien? All right, a type of voluntary lien would be a mortgage. When you get a loan from the bank, that's a voluntary lien. Nice job. A mortgage clause, which states that should the borrower sell the property, the entire balance of her mortgage would due immediately. This is known as the satisfaction clause, the due on sales clause, the estoppel certificate, or the acceleration clause. Okay, this is one of those where the answer is kind of in the question. It says when you sell the property, so the answer is due on sales clause. Okay, and this is normal when you get a loan. When you sell your property, it's very common that the lender has to be paid off at that time. So a due on sales clause is a pretty common thing. This one we went over before, but let's just look at it again. Sometimes people have a tough time with this. Carol made an offer to purchase Grace's property. As part of the offer, Carol agreed to take the property subject to an existing VA loan, which Greg obtained when they purchased the property in the approximate amount of $39,000. If Greg sells to Carol under these conditions, which of the following is true concerning liability for a loss suffered by the government after foreclosure on the loan? Greg will be primarily liable. Greg and Carol will be equally liable. Carol will be primarily liable. Neither person is liable because Carol took title subject to the existing loan. Okay, we went over this one before, so I'm going to be pretty quick on this one this time. And Greg will be liable because the seller is liable when it's subject to. The open-end clause of mortgage would benefit the borrower the most if he allows a subsequent buyer to assume the loan, had a loan subordinate to a construction loan, prepay the loan, or borrowed additional money. What do you guys think? And the answer is borrowed additional money. An open-end clause is kind of like having a credit card. The type of mortgage which permits borrowing additional funds at a later date is called an open-end mortgage, a junior mortgage, an extendable mortgage, or an equitable mortgage. Okay, once again, we're seeing the same concept asked in a different way. And like I said before, don't memorize the question, learn what an open-end mortgage is. When the real estate market changes from a buyer's market to a seller's market, which of the following results could naturally be expected? Construction activity in new subdivisions would decline. Prices would be unaffected since every parcel is unique. Price would probably drop because of the increased supply and reduced demand. Price would rise because of increased demand and lagging supply. What do you guys think? Good. So the price would rise. Seller's market, prices rise. When purchasing with FHA financing, a new buyer would normally do each of the following except A, pay for mortgage insurance protection, B, apply directly to a bank or savings and loan, C, apply to a local FHA office for the FHA appraisal, or D, buy a home with conforms with FHA requirements and restrictions. Okay, let's see what everybody thinks here. Big thing to be careful of is this word accept. Don't get fooled by that. As for the question, you always got to remember FHA does not make loans. So you not go to the FHA office to get a loan. FHA insured lender. The majority of money used for loans of real estate comes from A, co-op savings, B, government bonds, C, Federal Reserves, or D, individual savings. Okay, and the answer here, individual savings. That's right. When you deposit money in the bank, you're contributing to the real estate market. A credit score scales, excuse me. Ooh, it's been a lot of questions here. A credit score scale used by many mortgage lenders that use a risk-based system to determine the possibility that the borrower may default on financial obligations to the mortgage lender is known as pre-approval, FICO score, balance sheet, or preliminary report. What do you guys think? And their answer is FICO score. People always talk about having a good FICO score because that essentially shows how much risk you are. Remember, getting that loan is so much about determining the risk between your FICO score, your income, and the property. The lender wants to assess if they want to give you money. When obtaining a mortgage loan, the buyer often has to pay discount points. Those points are a percentage of A, the selling price minus the agent's commission, B, the loan amount plus closing costs, C, the loan amount, or D, the selling price of the property. What do you guys think? And it's a percentage point of the loan amount. Okay, we got two more to go here. When considering VA loans, the unique feature about down payments which are required is they are determined by the CRV. There may be no down payment. They vary according to the amount borrowed. They are never more than 3% of the CRV. Now remember, with the FHA loan, or excuse me, a loan that's insured by the FHA requires a small down payment. A VA loan does not, and that's what makes it unique. Got to know that for your exam. Okay, one more. The annual percentage rate is defined by the Federal Truth in Lending Law as the total of all costs which the borrower must pay to get the loan, the total of only the indirect costs of credit which the borrower must pay, the total of only the direct costs of credit paid to the borrower, the relative cost of credit expressed in percentage terms. See what you guys think here. And their answer is relative cost of credit expressed in percentage terms. It's there to make it simple for you to understand what you're paying, rather than when you get all these different fees like the ha-ha fee, the we screwed you tax, the you're a sucker charge, and you don't know what any of it means. It's all very confusing. The APR is supposed to dumb it down and make it easy so average people like you and I can get a loan and understand what they're paying, excuse me, what we're paying. All right. So that's all of them for right now. Now remember, if you guys have any questions and want to interact with other people taking the real estate exam, I highly recommend that you go to our Facebook group, okay? The Facebook group has interaction with people just like you to ask questions and to understand different concepts ranging from real property to financing to secondary market, and even some questions for what you're going to do after you pass. So with that being said, this is Joe from Prep Agent. Good to see everybody, and I hope to see you at the next webinar.